Okay, welcome to the latest edition of Share Views. I'm here with the Chief Investment Officer of CCLA, James Bevan. How are you today, James?
I'm in very good form. It's jolly warm, but that's fine, isn't it?
It is, even with the air conditioning on. Right, we're talking all things oil today.
We are.
And my first question actually is a very basic one, because sometimes it's good to start at the basics. From the way that the oil market's gone this year to date, and the way oil stocks have gone this year to date, the relationship between the two doesn't seem to be quite as intuitive as it could be.
Well, I think if you were to step back and think what has been driving commodity markets writ large and what are the other movers in the market, suspicion number one, of course, has to be on the dollar. And we have this very interesting arrangement where when the dollar goes up, we have commodity prices, and particularly oil prices, moving down. And actually, that's reasonably logical when one thinks about who is making the money, what are they going to do with the currencies they receive, and therefore what is their spending power in the global community. And we then have this very interesting issue. The stock markets are, of course, a barometer and not a thermometer. There is an appetite the market participants have to foretell the future. And frankly, I think that they are very optimistic about oil prices moving up materially from current levels.
But we got these forecasts from EIA, IEA, with all these acronyms coming through. Well, the first thing is they're rather bearish, and two, do they ever get it right?
Well, it's very interesting, isn't it, that in 1 month, both the International Energy Authority and OPEC have cut forecasts of demand relative to supply, and they now say there's going to be rampant oversupply and excess inventory, all of which is bearish in the near term. And it is, I guess, about trying to find a new equilibrium. What is, of course, encouraging, on the other hand, is that demand in America has been improving, and therefore, ultimately, we are likely to see some swing in production. But I do think that is primarily from the United States, rather than the OPEC and non-OPEC producers, which I suspect will continue to pump hard because they want the foreign currency earnings.
Isn't the other problem that, because of advances in technology and because of the fall in the oil price, the cost of production is falling lower and lower, which brings on more areas, the shale areas and other areas like that on tap, which means continues to keep the spiral in a downward direction.
Yeah, I mean, from the consumer's point of view, that's of course excellent. From a climate change perspective, it's very fine that we are beginning to see alternatives competing aggressively for their place in the energy mix. I guess that the shale revolution has been a very material surprise to the hydrocarbon participants, because nobody anticipated either the scale nor the longevity of pumping. Lots of people had said, yeah, there's gas there, but the pressure will diminish, and therefore the profitability will be much less than many people have projected. It's turning out to be the opposite. The capacity to keep pumping gas is far higher than had been suggested, as is the capacity to vary the output very easily. So I would say that liquid natural gas is a key competitor to traditional heavy carbons, and that realistically makes thermal coal and tar sands almost non-economic.
You wouldn't believe it, but I actually remember the 1973 oil embargo situation with OPEC and Sheikh Yamani, and the man was obviously a very cool person, but it worked as far as getting the oil price in the direction that OPEC wanted. It's been downhill ever since, and it's gone down to probably to a full circle with the alleged deal between Russia and Saudi Arabia just a couple of weeks back, when the oil price spiked, thinking that there was going to be some way of controlling production, but it's just not going to happen, is it? It's a farce.
I completely agree with you that we're not going to see very material constraints on supply. And at the same time, whilst many people had said, look, if you multiply up the number of people who've not yet got a motor car with the number of motor cars likely to be produced, the demand for oil is ever upwards. And in fact, we have seen the production of energy moving very substantially away from hydrocarbons, and the efficiency of the internal combustion engine materially improving. So the number of miles driven has risen at a far faster rate than the demand for hydrocarbons, and I think that trend will continue.
I mean, I've seen also, how much of a factor is the non-OPEC supply?
Oh, it's huge, absolutely important. And Russia wants all the foreign currency it can get. Norway wants to build its sovereign wealth fund. I mean, Norway's sovereign wealth fund now owns around 4% of every company in Europe. It's a very significant concern, and they obviously want to continue to increase the scale of that fund so long as they can.
And is that an influence? I mean, the non-OPEC situation, especially when combined with geopolitical concerns, it means there must be effectively dumping of oil going on behind closed doors.
There's a very interesting issue, isn't there, as to how much people just want cash flow. And the realization that if you have spent the capital to create the supply, the marginal cost of delivering the product to the marketplace is really surprisingly low. It's only when you need to get to new spend, which is obviously a huge issue for investors, do you really worry about what the future oil price will look like.
Right. I brought in the relationship between oil and oil stocks at the beginning of our little chat. I wanted to look at maybe some examples of, in this environment, what you think represents maybe value and where we should be looking and how we should play the way the landscape is at the moment.
Well, if we were to think about the hydrocarbon continuum in three slices, exploration and production, services, and the oil integrated and downstream, I would say that the exploration and production stocks are now all high risk. The premise that they will ever justify the sorts of risks that they have to take to deliver returns to shareholders looks really quite flaky to me. So I'm avoiding that area like the plague. In terms of services, again, I think there is a mismatch between market expectations of where prices will be, and therefore, by extension, the returns to shareholders. And the only stock within the services sector that I think merits consideration right now is Schlumberger. In the oil integrated, I think that the real players in town are Chevron and Exxon. They have a much better portfolio of future business. They have far more exposure to the lucrative, efficient, cheap shale gas reserves of North America. And I think both companies are in a position to grow shareholder value and pay progressive dividends.
But it strikes me, the cliche with the gold rush is that the people making the picks and shovels are the people who made the most money out of that particular frenzy of activity. Here, the support services of the oil services, the oil sector, those companies must be, many of them are FTSE 100 stocks or equivalent. They're going to be really hurting, aren't they, over the next years?
And there is still rampant oversupply and overcapacity. I mean, if one were to think about some of the contours of the global economy right now, one would have to argue that oversupply and inventory overhang that pervades every industry, which creates deflationary impetus, is going to stay here for a long while. And the only entities, therefore, who will be able to survive are those who can cope with very low pricing trends and which have natural capacity to grow productivity and output at low cost.
Right, the other thing the read across from gold is that when we had the bear market in gold from 2011 to the beginning of this year, and the only way you could really be sure of safety is that you looked at the gold price at $1,100 an ounce, and you saw a company which was producing it at $600 or $700, and said, well, that's they can't lose, so I'll buy some of them. With the oil producers, isn't it the same thing? I think there was Pantheon Resources, which is a smaller company, which a lot of private investors just burnt their fingers on. But the initial premise there was that they were producing oil at $4 or $5 a barrel. So they didn't care even if the oil price was $26 or $28 a barrel. Is that how ruthless you've got to be in picking out oil stocks now?
I think you not only need to be ruthless in terms of the cost of production, you need to think very carefully about what is the capital expenditure cycle and do the companies actually have the balance sheet strength to continue to invest? Because what is very clear from historic experience is a lot of the E&P stocks, the exploration and production players, who are very good about the news flow in terms of when they've done well, actually eat capital like it's going out of fashion. And they're the companies, ultimately, that can scythe investors off at the knee, particularly have stretched balance sheet, heavily dependent on leverage, in an environment where leverage is increasingly rationed.
So it's not just about the cost of production, it's actually the balance sheet, the bank balance that they have.
Yeah, absolutely it is. Because we're going to be in an environment where the oil price will be volatile. We need companies to be able to survive on their current capital structure for an extended period with very difficult cash flow characteristics.
Right, finally, is this going to be an environment where there's going to be M&A, and we had the Shell rolled out Shell taking over BG. Is there going to be more of that going on, which will at least it gives a bit of it's not cheer to this.
I'm quite convinced there'll be a lot of M&A because companies will look at their prospects, and as Royal Dutch Shell looked at BG and thought, look, we have this fantastic opportunity to acquire assets that will change the profile of our business, allow us to create some shareholder value, and in a European context, Royal Dutch Shell is delivering. It's just, in my view, second best to the opportunity represented by Chevron and Exxon.
And does that mean that we're going to be looking more at the larger companies taking over each other, or the largest companies going for smaller assets?
Well, I think that we'll have both this horizontal integration, trying to buy competitors to get capacity and breadth within markets, but also this vertical integration where people are going to try and buy technology and know-how. And if you can acquire some of the better technology or opportunity to reduce your cost of production, and therefore steal a march over competitors in a climate where pricing trends are going to remain hostile, that's got to be a good thing.
Right, finally, there's been a lot of talk, well, there's an extra final question, a lot of talk about the situation in the UK with the Horse Hill and other speculative areas. Is that ever really going to take off, you think, in terms of the promise that we've had there?
I'm very optimistic that we will end up with an integrated and expansionary energy policy for the UK. And I think there will be plenty of players in the UK who will benefit from this. It's just that the political process of getting real commitment to driving the macro environment will support these opportunities is very, very slow.
So it's like a Victorian backdrop as far as...
Yeah, I think Mrs May is a pragmatist, and I think that Mr Hammond, in his autumn statement, 23rd of November, will be looking to be expansive fiscally. And inevitably, he will be very focused on thinking about what are the future energy requirements of this economy, how are they best met.
Is the North Sea a dead duck? Is it going to turn into that?
But you know, I'm very surprised how successful the North Sea is at continuing to deliver some value. But if you go to Aberdeen and see the depression up there amongst the people, you have to say it's going to be really difficult and quite slim pickings.
Right, well, on that note, James Bevan, Chief Investment Officer at CCLA, thank you very much for making Share Views an exciting watch today. Thank you very much. We'll be back next week.